Talk about the income limits that apply for when you're going to put money into a Roth account. So if you're going to make a contribution to a Roth account as opposed to doing one of these conversions.
It's a good distinction to draw because the restrictions on conversions have been lifted, but the restrictions on contributions have not. So if you're a single person, the ability to contribute to a Roth IRA phases out between modified adjusted gross income of $105,000 and $120,000 a year. If you are married filing joint, that phases out between $166,000 and $176,000 a year. And if you're married filing separately, it phases out between $0 and $10,000 a year. So most folks find it difficult once they're getting along in the income earning years of their life to keep making those contributions to a Roth IRA. And, but like I said before, the income restrictions for conversions have been lifted likely forever.
Yeah, we hope.
We hope.
So, okay. So, and now in past years it was like $100,000, right?
It was.
Yeah. So if you had $100,000 of adjusted gross income, you just couldn't do this. So that basically everybody put it out of their mind. I can't do this conversion.
That's right.
And now that limitation has gone away, but we have to distinguish again. When can we convert, as opposed to when we can make the contribution? Okay, so, and I think I don't know if yeah, let's go ahead. So, can you use an existing Roth account for a conversion? So I've already got a Roth account and I've got an IRA account.
You can. You can use any existing Roth IRA account. You can convert your traditional retirement account into that Roth IRA, but it may not be a good idea because should you choose to recharacterize that back to a traditional retirement account, it's going to be very difficult to do good accounting, given that those funds have been commingled. So.
Okay, so that sort of leads to our next question. That is, can you change your mind about making a conversion?
You can actually. If you convert to a Roth IRA and you change your mind, you can recharacterize the account back to a traditional retirement account, as long as you do it before the day that the taxes are due in the next year. So if you convert an IRA in 2010, you can recharacterize back to an IRA by April 15th of 2011, or if you file for an extension, even later.
Yeah.
And that basically, in the eyes of the IRS, means that no conversion ever occurred.
Right. So one thing that people are concerned about is, well, what if I make this conversion and then the market drops dramatically?
Yeah.
Okay, now I've reported all this income, and yet I don't have a lot of value sitting here in this Roth account for what I've gone through.
That would be an expensive transaction.
Right.
Yeah.
So if you have that sort of a scenario, basically you can undo the deed and treat it as if it was not. But you want to keep it again in that separate account if you're thinking that may be a concern for you, because otherwise tracing it will be pretty tricky. Okay, so and then you get another chance the next year.
That's right.
So, but 2010 is the only year that we do the thing where we can have it taxed in the next 2 years.
That's right.
Whereas usually it's going to be, we have to have it taxed in the year of the conversion. Okay. Now, does a conversion have to be done in cash?
No. You can keep your stocks, bonds, mutual funds in your account. You can ledger them over in kind, but you do have to have a value for the assets on the date of the conversion.
Right. So this is a concern for certain types of assets. So we've talked on this show before about the self-directed individual retirement accounts or Roth accounts, where people are making alternative investments. They may be holding real estate in the account. They may be holding a private mortgage, or they may be holding stock in a closely held company that's not publicly traded. So there is going to be, for those situations, an additional expense. If it's publicly traded, you can get a value, no problem, because you've got the market values each day that are posted and you're allowed to use those. But if you have these other types of assets, you're probably going to have to get an appraisal or an evaluation study done. And that means you got an additional expense in order to make the conversion. And so you need to think about that. And also you need to think about it related to this business of changing your mind, because
That's
if you
right.
change your mind, do it again, then you've got this expense each time that you try to do it.
You know, one option in that example could be a partial conversion.
Oh, yeah.
You could convert the portion of the account that's in equities
Sure.
and leave the alternative asset.
That could be a choice. But anyway, so you just need to be aware that this is a requirement. Okay. So here's one that people are talking about a bit. Is what if I make a non-deductible IRA contribution, and then I take that account and I convert it to a Roth account? Can I use that to get around the Roth limitations? In other words, basically qualify to get a Roth contribution where I couldn't usually.
Right. Someone who makes too much money to contribute to a Roth, essentially contributing. And so there's two different answers, one for people who have IRA accounts or traditional retirement accounts, and one for people who don't. If you don't currently have other retirement accounts, you can make the non-deductible contributions and convert to a Roth IRA, and that's fine. If you do have regular IRA accounts at the time of the conversion, then conversions of those non-deductible contributions cause prorated income amount based on all of the accounts to be taxed.
Right.
So it becomes a complicated situation again.
Right, yeah. So it's going to carry some taxable income, and so you won't just get a non-deductible IRA contribution but have no tax for the conversion. It's going to carry some income with it. And the reason is that when you're making these distributions and conversions, all of your IRAs are treated as if they're one account.
Right.
Okay, yeah. All right, so when do you think it's advantageous to convert?
So the first thing is that you want to make sure you can afford to pay the taxes. If you are younger than age 59 and a half, the IRS does not allow you to make distributions from a traditional retirement account to pay the tax. So you need to probably have cash on the side, enough to pay the income tax that you're going to expect.
So you can make the distribution. The problem is you got to pay a penalty to do it.
That's right. I'm sorry. I should have said they don't allow you to do it penalty-free. So
Right.
you'd pay at least a 10% penalty
Right.
if you're younger than 59 and a half. And that may mitigate the tax benefits that you expect to receive in the future.
Right.
You want to plan to keep the account long-term, because obviously the benefits of the compounding mean you want to probably have a 15 to 20-year time horizon for that account before you're going to need to distribute from it to allow it to go ahead and grow, so that you have that tax-free growth.
Okay, why don't we stop for just a second here? So, because I want to mention that the life expectancy of a married couple that's about age 62, when most people retire, is about 30 years. And so if there's two of you, there's a good chance that that's going to be there for a long time. Again, an average of about 30 years. It may be less for the particular couple, and it depends on whether you smoke and all those things too.
Yeah.
So anyway, but that's an important thing to think about, because a lot of people think, oh, I don't have that much time left. I'm getting old. I'm age 62. It's not going to be there, but it can be there for a long time. And there's one other thing, and that is, since you don't have to take the money out during your lifetime, if the balance is there at your death or the death of the second spouse, it goes to the kids, and they don't have to take the money out right away either. So it can continue to grow while they're holding the account.
That's right. No, we've done several conversions for clients who are in their 60s. It's a good time if you don't need to live off the account. If you have other assets or a pension or whatever is your income, if you don't need to draw from that account, then you definitely could consider a conversion.
Okay, and why don't you go ahead then for your next item?
Okay, so for conditions for it being advantageous to convert to a Roth. If you think that your income tax rate is going to increase over time, and one thing I'll stop and note here is that a lot of people assume that their income tax, their marginal tax bracket is going to decrease